Markets don't move randomly, they move in patterns, driven by behavior, structure, and narrative. Hey everyone, welcome back. In our previous investigations, we explored pre-sale versus after-sale dynamics, the phased unlock schedule, and the June tipping point, highlighting early volatility. Today, we're diving deep into phase 1 of BlockDAG, explaining how the price was formed, the role of liquidity, frozen supply, retail behavior, and why the token crashed nearly 93%. When BDAG listed on centralized exchanges like CoinStore, the team coordinated months in advance. They negotiated listing fees, trading pairs, marketing campaigns, and technical compliance. Part of this process involved setting up an initial liquidity pool of around 4.5 billion tokens, roughly 16% of the circulating supply. Market makers were deployed to stabilize the order book by placing simultaneous buy and sell orders to prevent chaotic price swings. Looking at tokenomics, BDAG has a total supply of 150 billion tokens. 50% is allocated to miners as mining rewards, 33.3% to pre-sale investors, 12.7% for community and ecosystem initiatives, 3% allocated for liquidity pools, and 1% reserved for the team. During phase 1, pre-sale, after-sale, and miner tokens were frozen. Only the liquidity pool and retail aftermarket, roughly 5 to 8% of circulating supply, were active in the market. With such a thin pool, the market became extremely sensitive to even small sell pressure. The strategy of frozen supply was intentional. The team aimed to control token distribution, prevent mass dumping, enable phased listing, align long-term interests, and build ecosystem awareness before a major supply entered the market. On paper, this strategy promised stable price growth and protection against dump. Phase 1 revealed a different reality. According to CoinMarketCap, BDAG initially surged from around 0.1063 USD to a peak above 0.5 USD, driven by hype and limited supply. By 23 of March 2026, the price had dropped to 0.007067 USD, a decline of 93.35% from its all-time high, even though most of the supply was still frozen. Retail investors exercised their rights to sell, and market makers could only partially stabilize the order book. This crash did not occur because retail investors or market makers acted improperly. Retail was exercising legitimate rights, market makers were stabilizing orders, and frozen supply prevented pre-sale, after-sale, or miner tokens from entering the market. The root cause lies in structural design decisions. The liquidity pool was too small relative to early demand, the initial price was overvalued. Retail selling power in a thin market was enough to trigger extreme volatility, and market makers could not add tokens to absorb slippage. The team knew supply was limited, but they likely underestimated how sensitive the market would be. The growth strategy narrative promised stability, but in reality, the combination of a thin liquidity pool, overvalued initial price, and retail selling caused a 93% crash, clearly reflected in the market data. From a market behavior perspective, this is a textbook example of how structure, investor behavior, and narrative interact. Even a small percentage of circulating supply in a thin market can trigger outsized moves. Price moves are not random. They are a reaction to active supply, retail behavior, and liquidity design. Frozen supply remains a strategic tool for long-term growth, but in early phases with limited liquidity, the market is inherently volatile. The phase 1 crash is not accidental. It is a direct consequence of structural design decisions, including the size of the liquidity pool and initial pricing. Investors should understand the difference between strategy narrative and actual market mechanics. Conduct your own research. Pay attention to liquidity, unlock schedules, and market sensitivity. If you found this investigation insightful, please like, comment, and subscribe to Bias Positive Digital Rise. We will continue exploring market structures, investor behavior, and narratives that shape crypto price action.